a look at the time value of money concepts. And here we're going to look at the general concepts of the time value of money and compound interest. There's a relationship between time and money. So if I offered you $20 today, or you could choose that I will give you $20 a year from now, which would you take? Well, most of you would probably say, I want the $20 today, because number one, you can actually use it sooner rather than later, and that's worth something to you. And secondly, you could invest it into something, and by a year from now, you would end up having more than $20. So why would you just wait and have $20 next year? Okay, and so these are the concepts that we're taking a look at. When we go to put numbers on the balance sheet, if it's something that's a current asset or a current liability, we show it at the full maturity level, because a year from now is still not that big of a difference in time. But when you're talking about something that's 10 years from now, it's a pretty significant difference as to what that thing is worth or how much we owe on that thing. Here are some things that we tend to use a present value for, instead of just saying, what is this thing worth 10 years from now, or how much do we owe 10 years from now? We're going to say, what is that same number? What is the value of it today? Okay, and so that's called present value accounting measures that we're going to attach to these things. So notes, and these would be long-term, again, long-term notes receivable or long-term notes payable, leases, pensions. We'll be talking about leases and accounting for leases at the end of the semester. Pensions, so if we owe money out to retirees, okay, and we have to save that money up to be able to pay them, okay, then that's a long-term liability, okay. Long-term assets, so if we buy equipment that we're going to use for 10 years, how much is that worth, okay, etc. That's going to go on. So these are some of the most common things that we're going to use this present value accounting measures on. Now, the nature of interest is that it's the payment for the use of money. So if you put money into an investment, and that investment gets to use your money for their own good, then they have to pay you something, and that's called interest. If you loan somebody money and they're going to pay you back, well, again, if they're paying you back years from now, they need to pay you some interest to cover the cost of them getting to use the money. Okay, so whatever that excess amount is above the amount that was lent or borrowed or whatever, that part, the part that was lent or borrowed, that's called the principal. Okay, whatever was received or paid above and beyond the principal is the interest. We have various three main variables whenever we're doing interest: the principal, the interest rate, and time, how much time has gone by. If time is 0, then there is no interest. Okay? The interest rate is always put in terms of an annual, once a year rate, and we need to adjust things if it's less than a year. Here's an example here. Barstow Electric borrows $10,000 for 3 years. A simple interest rate of 8% per year. Okay, so we want to know how much interest would there be for 1 year. Okay, we use our simple interest formula. I'm sure you've had this formula in other classes by this time, and that interest is the principal times the rate times the time. So our principal in this case is the 10,000. Our rate is 8%, and we put that in terms of a decimal, so 8%. We move the decimal over 2 places to the left, we get 0.08, and times 1 year. Okay, and so that's $800 for a year. If this was 3 years and we were using simple interest rate, we would be talking about $800 times 3, be $2,400. So Barstow, when they pay this loan back, they would have to pay the $10,000 back plus the $2,400 for 3 years of interest. Okay, what if they borrowed it for 3 months instead of 3 years? Okay, well, when we're doing the time part, I equals P times R times T, when we do the T, the time part, we're going to put that in months, or we can put it even in days. Okay, and so the numerator of that fraction, if we have less than 1 year, okay, we're going to have a fraction, and the numerator will be how many months is the loan for, and the denominator will be 12 months. We have 12 months in a year. Okay, so 10,000 principal times 0.08 rate times 3/12 is $240, okay, of interest that Barstow would owe if it was a 3-month loan. I could also have done this in days. So the number of days of the loan, is a 90-day loan. That would go in the numerator. And how many days are there in the year? Traditionally, in the world of finance, we use 360 as that denominator. That was back when a lot of calculations were not done by computers. And so they used that 360 because it was just simpler. Okay, so now that we have computers, oftentimes the denominator is 365 days a year instead of 360. So that can make a very slight difference. Now, what we're going to be talking about the rest of these videos and PowerPoints on the time value of money is not the simple interest rate, because typically we're only going to use the simple interest rate if it's less than a year. Okay, and so what we use if it's more than a year is a compound interest. Now, with the simple interest, we only calculated the interest on the principal itself. But with compound interest, we're computing the interest on the principal and on whatever interest we've earned so far. And this is the typical interest we're gonna be using. So here is an example. Tomall Company deposits $10,000 in the Last National Bank, where it will earn simple interest of 9% per year. Deposits another $10,000 in First State Bank, where it will earn compound interest of 9% per year, same amount, same rate, but compounded once a year, compounded annually. In both cases, Tomall will not withdraw anything until 3 years from the date of deposit, and then they'll take everything out if that's their plan. Okay, so on the left down here, we have the Last National Bank. We see the principal, which is the $10,000 deposit that they put in the bank, times the 9% rate, and they don't show it, but it's times 1 year, times 1, and that's $900 of simple interest. So we take the $10,000 that was deposited, add the $900 extra interest that the bank's going to give them, and they would have at the end of the first year $10,900. Then in year 2, again, we take just the principal times the 9% times 1, that's another $900 the second year. We add that to what we had already. We had $10,900 sitting in the account. Now we got another $900 dumped on top of that. So now there's $11,800 sitting in the account. Year 3, we take the principal again. 10,000 times 9% times 1 is another $900. We add that to the 11,800 that we already had, and now we have 12,700 at the end of the 3 years sitting in the account. Okay, out of that 12,700, 2,700 is interest, and 10,000, of course, is just a return of the original deposit. Now, what about at the First State Bank? Here's where we had compound interest. So the first year is the same, though. The first year, all we have is the principal going in times the 9% times 1 is $900. And we add that to the 10,000, and we have at the end of the first year 10,900. First year is totally the same. Now it's in the second year that we have a difference, because now instead of just the principal in our calculation, we're going to use whatever was in the account, which includes principal and interest from the first year. So 10,900 times 9% times 1 is $981 of compound interest. Now I'm going to add that to the previous balance of 10,900, and I have 11,881 now in the account. In the third year, I take the balance, 11,881, which includes the principal and 2 years worth of interest, and I multiply it times the 9% times 1. I get $1,069.29. I add that to the previous balance, and now at the end of 3 years, we have $12,950.29. Out of that, $2,950.29 is interest. So we put 10,000 in at the beginning of year 1. We walked away. We didn't do anything for 3 years. We come back and we have $250 more in First State Bank than what we had in Last National Bank, simply because they compounded it. And they only compounded it once a year. The more often they compound it, the bigger that difference is. So many banks compound every day. So you can get the most benefit out of that compounding. Now we have compound interest tables are in the back of your book. There are various other compound interest tables available and in various books or places. Sometimes these tables are numbered 1 through 6. There's a future value of 1, present value of 1, future value of an ordinary annuity, present value of an ordinary annuity, and future and present value of annuity dues. If all 6 tables are there, this might be the order that they're in, but all the tables, no matter what book they're in, use these same titles, but they might use a different numbering system. They might do things slightly differently, okay? But the table, the title of the table will still be the same. The number of periods is going to be the number of years times the number of compounding periods per year. So if we're compounding twice a year, I'm going to take how many years it was. Like in the previous example, we had 3 years that the deposit was sitting in there. So 3 years times twice a year compounding would be, I'm going to use 6 periods when I'm calculating out the problem. The interest rate, on the other hand, I'm going to divide by the number of compounding periods. So in the previous example, our interest rate was 9%. So if we were compounding twice a year, I would take 9 divided by 2. and I would use 4.5% every 6 months as opposed to 9% every year as I was making my calculations. The compound interest tables are made up through the use of formulas. Here is the formula for a future value of 1, which we saw in the previous slide was table 1. Okay, and so here's the official formula. And you can, of course, use these formulas on your calculator or whatever, but it can get a little bit sloppy and messy. Okay, you have to take, to get the factor, you have to take 1 plus the interest rate to the power of the number of periods. Okay, and so rather than do that, these tables, these compound interest tables that we're talking about, they took these formulas and calculated out what the answer is. If I have a 9% interest rate and I have 3 years, okay, then they would have calculated that out and put that number in the table under the 9% column in the 3-year row. And so the tables are so much easier to use than using these formulas. But just know that's where the numbers that are in the tables, that's where they came from, was from calculating out these formulas. Okay, so you don't need the formulas, and the various formulas are in your textbook. You're more than welcome to look at them. If you're one of those math whiz type of people, you're welcome to use the formulas. Okay, for the rest of us, okay, the tables are so much easier. You don't need the formulas if you're using the tables. Okay, also, if you use Excel, if you use a financial calculator, or if there's apps for your phone or tablet that have these formulas and tables already built in. Okay, choosing the correct table that you're going to use to solve a problem, that's the key to solving that problem. So we're going to carefully go through the various problems and how to solve them using the tables so that you can hopefully see what is the correct table to use. So there's 2 kinds of problems that we have. There's a single sum problems and there's annuity problems. So the single sum problems, according to the tables that were listed a couple slides ago, would be tables 1 and 2, and for annuities would be tables 3, 4, 5, and 6, according to the list a couple of slides ago. Okay, but again, different books show and number the tables differently. The titles of the table are similar, and in the next video, we'll go over the